Sir, very happy evening to all. So we are doing capital structure decisions. In that, we have already completed the cost of capital. Cost of capital in the sense means how to find out the KD, how to find out the KE, how to find out the KP, how to find out the KR, and how to find out the KO. Sir, the purpose of finding out the overall cost of capital is to use for the capital budgeting decisions, right, sir? So, my dear lovable students, then we have talked about the capital structure theories. If two firms are alike in all aspects, except capital structure, will the value of firm change or not is the discussion. Yes, the value of the firm change is what theory of relevance. No, the value of the firm will not change is what theory of irrelevance. Then, after that, we have talked about the arbitrage process. That is a process introduced by Modigliani and Miller. Two type of arbitrage, primary arbitrage and secondary arbitrage. That is, two firms will be there, levered firm and the unlevered firm. Sir, because of tax, if the value of the levered firm is higher, people will start selling the securities of the levered firm and they will shift to the unlevered firm. This is called as primary arbitrage. Sir, because of any reason, if the value of the unlevered firm is higher than the value of the levered firm, then the secondary arbitrage will work. Now, we are pending with one topic called as, EBIT-EPS analysis. EBIT-EPS analysis. This is an expected area for examination. I will tell you, man, actually in the whole chapter, we have not discussed in a capital structure, how much should be the percentage of equity, how much should be the percentage of debt, how much should be the percentage of preference share capital, and how much should be the percentage of reserves and surplus. Actually, in the world, there is no concrete formula that 70% equity, 30% debt, 10% preference. Such a percentage, no one can propagate. No one can bring that such a percentage. So, my dear lovable students, we have to choose a percentage which will suit us well. For example, if I am wearing white color shirt, it's not suiting for me. If I wear blue color, if it's good for me, I have to wear the blue color. The same way, under what option company's EPS is higher, that option is the perfect capital mix. That should be adopted by the company. That is called as capital structure decisions. So we are going to take the decision. In my capital structure, how much percent should be equity, how much percent should be debt, how much should be preference. Sir, taking such a decision is called as capital structure decisions. First question we are going to do from that area. This is a May 2022 past examination question. Look at the length of the question. So if you are preparing for your examination, we can't have an assumption that like this question and all will not come. This is a very past examination question. So that respect we have to give to this area. The particulars relating to Raj Limited for the year ended 31st March are given as follows. Output units at normal capacity 1 lakh unit. That means this company or the firm is having the capacity to produce 1 lakh unit. Selling price per unit 40. 1 unit can be sold for 40 rupees. Variable cost is 20. So 40 minus 20 will be 20 will be the contribution per unit. Fixed cost already given as 10 lakh. Capital structure of the company as at 31st March. That means already existing company, man. Equity share capital total 10 lakh with equity shares of 10 each at the rate of 1 lakh at the rate of 10 each. They are having reserves and surplus of 5 lakh. They are having current liabilities of 5 lakh. Total comes to 20 lakhs. So 20 lakh is the existing capital employed. Raj Limited has decided to undertake an expansion project to use the market potential that will involve another 20 lakh. That means company is going to do a project. To do new project, company need fund. So how much is the capital required? 20 lakh. Company expects an increase in output by 50%. Currently, number of units is 1 lakh. But if the company doing this project, instead of 1 lakh, they can sell 1,50,000 units. Fixed cost will be increased by rupees 5 lakh. Already existing fixed cost of 10 lakh. If I do the new project, it will increase for another 5 lakh. And variable cost per unit will decrease by 15% because of economies of scale. That means If I am producing less number of unit, automatically per unit cost will be higher. If I am going to manufacture more number of unit, to my supplier, I can bargain for discount. Enangaya, this much units I am purchasing. No, please provide me what? Discount. So automatically raw material cost per unit will reduce. The additional output can be sold at the existing selling price without any adverse impact on the market. Still demand is there in the market. If we increase the number of units also, there are so many customers are ready to buy the product. Following alternative scheme for financing the proposal expansion program are planned. Alternative number 1, alternative number 2, alternative number 3. How much lakhs we need? 20 lakhs. Debt 5 lakh, that means balance equity 15 lakhs. Debt 10 lakh, that means balance equity 10 lakhs. 14 lakh debt, balance equity. Current market price per share is 200 rupees. In market, now the shares is going at 200. Slab-wise interest rate, sir, for fund borrowed is as follows. If you are borrowing debt up to an amount of 5 lakh, interest rate applicable will be 10%. Over 5 lakh, up to 10 lakh, KD will be 15%. Over 10 lakh, KD will be 20%. Find out which of the above mentioned alternative would you recommend for Raj with reference to EPS, assuming a corporate tax rate is 40%. So, company is an existing company. Company will be having already EBIT. Company is going to do a new project with an additional capital of 20 lakh. When they put 20 lakh, they will get additional EBIT. Once they get additional EBIT, sir, in which option out of the 3 proposal, under which proposal my EPS will be higher is what the decision I have to take. So I am having how many alternative? 3 alternative. Alternative number 1, alternative number 2, alternative number 3. What is alternative number 1? Raising debt of 5 lakh and equity of, because 5 plus 15 total 20 lakhs. Alternate number 2, raising debt of 10 lakh and equity of, which comes to 10 plus 10 comes to 20 lakhs. Alternate number 3, raising debt of 14 lakh, balance equity of, so 14 plus 6 comes to 20 lakhs. Are you really with me? So what I am going to calculate the earnings per share. Earnings per share. Because I have to choose an option where my EPS is higher. My EPS is higher. So can I calculate the expected EBIT? Yes, sir. Sir, I am going to calculate the expected EBIT. By seeing the question, you say, how much number of units currently we are selling? 1 lakh. 1 lakh units. If I pump additional 20 lakh into my business, I can increase the production. And my output will increase by 50%. So my new number of units will be 1,50,000. 1,50,000 unit. And they said that even though the number of units increases, sale price will not get affected. So what is the selling price per unit? 40. 40. Sir, what is the old variable cost? 20. Because of increase in the production, we can enjoy the economies of scale. Sir, because of economies of scale, variable cost per unit reduces by 15%. That means new variable cost will be 85% of the existing. Correct? So 20 into 85% comes to 17 rupees. Comfortable? So the new contribution will be how much lakh? 23 lakhs. 23 rupees. 23 rupees per unit. Per unit. How many unit you are going to sell? 1,50,000. So 1,50,000 into 23 comes to 34,50,000 is the total contribution. Total contribution. Right, sir? You know marginal costing, sales minus variable cost, contribution, minus fixed cost, profit. Now I reach the contribution. I have to reduce the fixed cost. Already I am incurring fixed cost of 10 lakh. When I do the new project, I have to incur additional fixed cost of 5 lakh. Total fixed cost I have to incur will be 15 lakh. So from 34,50,000 minus 15 lakh, 19,50,000 will be my new EBIT. Let me ask you a question. Whether you are doing the project by all equity, or fully debt or equity and debt, will the EBIT change? No. The EBIT is not a financing decision. It is an operating decision. Right, sir? So, my dear lovable students, 19 lakh 50, 19 lakh 50, 19 lakh 50 is the EBIT, earnings before interest and tax. Sir, am I going to employ same debt in all option or different debt in different option? Different debt in different option. So, if the debt changes, automatically interest changes. And the debt, here it is performing as per traditional approach. Because traditional approach said that if you inject more and more debt into the capital structure, even the KD increases. So the KD, as per the question, is a traditional approach question. Right? In option number 1, I am going to borrow to the extent of only 5 lakh. And they said that if I borrow only 5 lakh, so the interest rate will be 10%. So 5 lakh into 10%, 50,000 will be the interest for option or alternate number 1. Can I proceed? But they specifically said that if I am borrowing over and above how much lakh? 5 lakh up to 10 lakh, my interest will raise to 15%. It's slab system. It is what? Slab wise. Sir, if you are traveling through optional tax regime, up to 2.5 lakhs nil. Sir, 2.5 lakhs to 5 lakh at 5%, 5 lakh to 10 lakh at 20%, more than 10 lakh at 30%. Right, sir? Let me ask you a basic question. My income is 5 lakh. If my income is 5 lakh or above 5 lakh, will the entire 5 lakh will be taxed at 20%? Or I can still enjoy the basic exemption limit? The same what the slab wise meaning is all about. If it is more than 5 lakh up to 10 lakh, you have to calculate slab wise. That means for alternative number 2, for the first 5 lakh into 10%, 50,000. For the next 5 lakh into 15%, come to 75,000. Students will do a mistake here. They may apply entire 15% on the 10 lakh because they said that slab wise. So 50,000 plus 75,000 comes to lakh and 25,000 is the total interest under option number 2. Coming to alternate number 3, my dear lovable students. Sir, I am going to employ 14 lakhs debt. Correct? If you employ 14 lakhs debt over and above 10 lakh, how much percent? 3 slabs will come. First slab up to how much lakh? 5 lakh at the rate of 10% comes to 50,000. Next 5 lakh at the rate of 15% comes to 75,000. Comfortable? And 4 lakhs into 20% comes to 80,000. Are you all really with me? So 50 plus 75,000 plus 80,000 comes to 2,05,000 will be the interest in third option, alternate number 3. Sir, have I finalized EBIT? Same EBIT under all the option or different EBIT? Now I have to reduce the interest. Same interest, different interest. Why different interest? Different debt. So different interest. Right, sir? In option number 1, 50,000. Comfortable. Option number 2, 1,25,000. And option number 3, 2,05,000. So you'll be getting earnings before tax. From 19 lakh 50, if you reduce 50,000, you will get 19 lakh. From 19 lakh 50, if you reduce 1,25,000, 18 lakh 25,000. From 19 lakh 50, if you reduce 2,05,000, you will get 17 lakh 45,000. Pay the tax at the rate of, sir, I am not calculating 40, I am straight away calculating 60. Can I? So my dear lovable students, 19 lakhs into 60% comes to 11 lakh 40,000. Sir, 18 lakh 25,000 into 60% comes to 10 lakh 95,000. 17 lakh 45,000 into 60% comes to 10 lakh 47,000. Are you all really with me? Now, if one part of the capital required if I raise by debt, the other part has to be raised by equity. Already I am having number of equity. Yes, sir. Already I am having number of equity shares are there. And now I am going to raise fund by issuing additional equity. Right, sir? So what is the number of equity share to be issued? My dear lovable students, what is the total capital employed? 20 lakhs. Out of that, in alternate number 1, debt 5 lakhs. Up at 20 lakhs minus 5 lakh, 15 lakhs. So 15 lakhs has to be raised by way of equity. And for every equity share, 200 rupees is the market price. So 15 lakhs divided by 200. 7,500 additional shares I have to issue. Comfortable? Are you really with me? Already you are having existing number of shares. Can you say how much is the existing number of share? 1 lakh. Whether it is alternate number 1, alternate number 2, alternate number 3, the existing number of share will not change. Clarity? In alternate number 1, I have to raise additional equity share of 7,500. So the total number of equity share will be 1,07,500. Why are you calculating? Then only I can calculate EPS. Because EPS means residual earnings divided by number of equity share. But if I am traveling through alternate number 2, sir, there the debt increases. Out of 20 lakh, 10 lakh, I am raising by way of debt. That means balance 10 lakh, I have to raise by way of equity. And for every equity share, the current market price is 200. So 10 lakh divided by 200 means 5,000 number of equity share I am supposed to issue. Comfortable? Already I am having 1 lakh share, additional share 5,000, and the total number of equity share will be 1,05,000. In alternate number 3, even I am injecting more debt. That means out of 20 lakh, if I inject 14 lakh debt, balance 7 lakh, 6 lakhs will be the equity to be raised. Are you all really with me? And every share in the market is 200. So 6 lakhs divided by 200 comes to 3,000 shares is what I'm supposed to issue. That means if debt increases, equity reduces. If equity reduces, automatically number of equity shares also reduces. So existing 1 lakh plus 3,000 comes to lakh and 3,000. Sir, I already have PAT. Now number of equity shares. First case 1 lakh 7,500. Second case 1 lakh 5,000. Third case 1 lakh 3,000. So in first case, sir, 10.6 is the EPS. In second case, 10.43 is the EPS. And in third case, 10.17 is the EPS. You tell me which is the option having highest EPS. That's what you have to write as conclusion, man. Alternate number 1, raising debt of 5 lakh and equity of 15 lakh is recommended, which maximizes the EPS. If your goal is to increase the EPS, please follow alternate number 1. That will give you the best EPS. Automatically, the wealth of the equity shareholders will be increasing. So in examination, such type of question will be asked, my dear lovable students, where you have to take a decision where under which option your EPS is the highest. Such decision taking chapter is called as capital structure decisions. Capital structure decision. By this question, you know what decision I have taken? I have taken a decision where in my capital structure, 5 lakh should be the debt and 15 lakh should be the equity. I am talking about the new one. Out of 20 lakh, 5 lakh should be the debt and 15 lakh should be the equity. That means till now we were worrying that there is no law in the FM saying that this much should be the percentage of equity, this much should be the percentage of debt, this much should be the preference, and this much should be the preference reserves and surplus. Taking such a decision is called as capital structure decisions. Comfortable? From this question number 1, we have completed, my dear lovable students. I am moving into the second question, which is illustration number N from this area. Can we? Sir, the management of RT Limited wants to raise its fund from market to meet out the financial demand of its long-term project. So this company need fund. Company has various combination of proposal to raise its fund. Yes. Proposal P, proposal Q, proposal R. Proposal P 100% from equity shares. That means it's an all equity option. All equity option. All equity option. Because I don't know whether they are having currently debt or not. The option is called as all equity option. Whereas with regard to Q, if you are traveling through option Q, 50% equity, 50% debt. It's 1:1 debt equity ratio. Are you really with me? If you are traveling through are 50% equity share and 50% preference shares. These are the other information. Cost of debt, KD, and preference shares is how much percent each? 12% each. KD is equal to 12% and even KP is equal to 12%. Generally, like this will not come. Because KD will be having tax benefit, whereas KP will not have tax benefit. KD should be cheaper than KP. Correct? Question if they said that both are 12, I can't change it and all. Tax rate is 40%. Equity shares of the face value of 10 each will be issued at a premium of how much per share? That means issue price will be 10 plus 10 comes to 20. Total investment to be raised is 80 lakh. How much lakh? 80 crore. 8 crores. 8 kodi. 8 kodi. So 8 crores I have to raise. Expected earnings before interest and tax, which is EBIT, is equal to 3 crores 60 lakhs. Right, sir? From the above proposal, management want to take advice from you for appropriate plan after computing the following, which is EPS. As an advisor, you have to choose a plan which is having the highest EPS and financial break-even point. What break-even point? What is the financial break-even point of the company? In costing, sir, you are calculating the operational break-even point. It can be calculated in number of units, fixed cost divided by CPU, or in value, fixed cost divided by PVR. Are you really with me? Yes, sir. Compute the EBIT range among the plan for the indifference. This is the third requirement of the question. So there are 3 requirements are there. And this is an RTP November 19 question. Very good question where you are hearing about the financial what even point and indifference. This is the maximum variety from this chapter you can get is capital, sir, sir, structure decisions. Can we? My first question to you, sir, whether you are adopting the plan PQR based on that, will the EBIT change? Will not change. Because EBIT is not a financing decision, it's an operating decision. Can I proceed? So 3 crore 60 lakh, 3 crore 60 lakh, 3 crore 60 lakhs. Are you really with me? What is plan number 1? It's all equity plan. It is what? All equity plan. What is the total capital required? 8 crores. Sir, so equity is equal to 8 crore. In plan number 2, equity 4 crores and debt 4 crores. Are you really with me? And with regard to R, my dear lovable students, sir, equity 4 crores and preference shares 4 crores. Always right at the Monday. Then it will be very easy for you to calculate the interest and workings and all. You will never go wrong. After writing this, you start even the EBIT also. You tell me less interest charge. In situation number 1, sir, in alternate number 1, will interest come? No, because it's an all equity option. In second, sir, second one, will interest come? Yes. My dear lovable students, what is the debt? 4 crores, 2, 4, 6, into what is the 12% comes to 48 lakhs is the interest. In the third option, there is no debt at all. Then how interest will come? So the earnings before tax will be 3 crore and 60 lakh. 3 crore 60 lakh minus 48 lakh comes to 3 crore 12 lakh and 3 crore and 60 lakhs. Comfortable? Less tax at the rate of 40%. Sir, 3 crore 60 lakhs into 40% comes to 1 crore 44 lakhs. Getting it? 3 crore 12 lakhs into 40% comes to 1 crore 24 lakh 80,000. 3 crore 60 lakhs into 40% comes to 1 crore 44. What is the PAT? Profit after tax at the rate of 60%. Balance only. 3 crore 60 minus 1 crore 44, 2 crore 16, 1 crore 87, 20,000, 2 crore 16 lakh. Less what dividend? In option number 1, there is no preference share capital at all. In option number 2, there is no preference share capital at all. But in option number 3, for this 4 crore, you are liable to pay the same 48 lakhs will be the preference dividend. Right? Mathematically should be same. So you will be getting earnings available to the equity shareholders. 2 crore 16 lakhs, 1 crore 87 lakh 20,000, 1 crore 68 lakhs. Comfortable? Now I have to calculate the number of equity shares. Can I calculate the number of equity share? already number of equity shares there are not there? Have they said anything about the existing? No, sir. No, sir. So the entire 8 crores you are going to raise by way of equity means 8 crores divided by 20. Calculator. 8 crores divided by 20 means 40 lakhs is the number of equity share. In the second case, 4 crore divided by 20 comes to 20 lakhs is the number of equity shares. Getting it? In third case, for again same 20 lakh because the remaining was preference shares. Can I proceed? So the EPS earnings per share 2 crore 16 lakhs divided by 40 lakhs comes to 5.4 per share if you are going with all equity. Always all equity will not give the best option because financial leverage will not work. Trading on equity will not work. So better to go with debt. So 1 crore 87 lakh 20,000 divided by 20 lakhs comes to 9.36. Are you really with me? Sir, 1 crore 68 lakhs divided by 20 lakhs comes to 8.4. So the best option is option 2. Option Q. I am taking this opportunity to explain one small concept. Sir, I introduced 4 crore debt. I introduced 4 crore preference. Correct. Both are having same KD, same KP. Still under the debt option, we are having the highest EPS. Because for debt, we are having tax benefit. But for preference shares, we don't have. That tax savings will be, sir, go to the equity shareholders. Go to the, if you see my dear lovable students, since I have adopted debt in my what structure? Capital structure, I have paid interest to the extent of 48 lakhs. 48 lakhs. Since I have debited 48 lakhs to my what account? P&L account. Sir, this 48 lakhs would have saved tax at the rate of 40%. At the rate of. So 48 lakhs into 40% comes to 19 lakh 20,000 would have been the tax saved, which is nothing. 1 crore 87 lakh 20,000 and 2 crore 16 lakh. Look at the difference. 2 crore 16 lakh minus 1 crore 87 lakh 20,000 comes to, sorry, tax. I wrongly took. 1 crore 44 lakh minus 1 crore 24 lakh 80,000. 1 crore 44 lakh minus 1 crore 24 lakh 80,000 comes to 19 lakh 20,000. 19 lakh. So this extra money will be there with financial plan Q. But this extra money won't be there with financial plan R. Right? This 19 lakh 20,000 will be enjoyed by the 20 lakh equity shareholders. Correct? So divided by 20 lakhs means 0.96 extra EPS the equity shareholders can enjoy. What is 8.4 plus 96 comes to? This is what 9.36. Look at here the exact EPS we have derived. Are you already with me? This is what happening inside in the financial structure. That's it. First part of the question done. The second part, financial break-even point. First understand what is the concept financial break-even point. It is a level of EBIT where your EPS should be 0. Your EPS should be 0. That means I am having some level of EBIT. With that I will pay interest. With that I will pay preference dividend. I won't have anything to the equity shareholders. Equity shareholders is saying that you paid interest, you paid preference dividend, and you paid tax on preference dividend. Are you totally with me? So in proposal number 1, there is no what at all? Debt at all. If there is no debt, if there is no preference, there is no question of financial break-even point at all. That's why it is 0. Comfortable. In second situation, second scenario, how much is the interest you are going to pay? 48 lakhs. That means if my EBIT is 48 lakh, I will pay that 48 lakhs as interest. Then my EBT will be 0. If there is no EBT, there is no tax. Then PAT will be 0. If 0 is the PAT, automatically EPS will be 0. Comfortable? So in the situation number 2, 48 lakhs will be the financial break-even point. That means if I am having an EBIT of 48 lakhs, my EPS will be 0. In situation number 3, I don't have interest. I have to pay preference. But in order to pay preference dividend, I have to pay tax on preference dividend. That is called as tax on preference dividend. Clarity? That means how much preference dividend I am going to pay? 48 lakhs. This will be, my dear lovable students, sir, 60%. Am I right? 60%. So calculator. 48 lakhs divided by 60% comes to, if I earn 80 lakhs of EBIT. Look at here. EBIT is how much lakh? 80 lakh. What is the interest I am supposed to pay? 0. Because in that option there is no debt at all. So the earnings before tax will be 80 lakhs. Right, sir? Less tax at the rate of 40%. So 80 lakh into 40% comes to 32 lakhs. Are you really with me? So 80 lakhs minus 32 lakhs comes to 48 lakhs is the profit after tax. That I will pay as preference dividend 48 lakhs, then automatically my residual earnings will become 0. If residual earnings is 0, EPS will be 0. Such a level of EBIT is called as financial break-even point. So 80 lakhs. Second part of the question also done. So through this question we have explained one concept called as financial. Then I'm moving into the computation of indifference point between the proposal. How many proposal? 3 proposal. Understand the concept of indifference point. Sir, I'm having 3 alternatives, sir. Alternatives classified into 3 categories. Alternate number 1, alternate number 2 and alternate number 3. My dear lovable students, if I am traveling through alternate number 1, sir, I should have an EPS. I should have a EPS. The same EPS I should get in alternate number 2. The same EPS I should get in alternate number 3. So, there is a level of EBIT. There is a level of EBIT where EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. That means at that level of EBIT, if you are choosing option number 1 or option number 2, you will be having same EPS. You will be having same EPS. That is called as indifference point. Now I am calculating indifference point. What point? Indifference point for alternate number 1, alternate number 2 and alternate number 3. Right, sir? But you can compare only 2 alternatives at one time. You cannot compare all the 3 alternatives at the same time. Sir, if they ask indifference point in question, nothing, just write the EBIT minus interest. Minus what? Interest. You will get earnings before tax. Less tax at the rate of 40%. You will get what? PAT. Profit after tax. Profit after tax. Pay the preference dividend. You will get the residual earnings. Residual earnings. Divided by number of equity shares. Number of equity shares. You will get the EPS. Earnings per share. Earnings per share. Comfortable? My dear lovable students, sir, you know the EBIT, you don't know the EBIT. Because indifference point is a level of EBIT where the EPS is same. If the EPS is 0, that is financial break-even point. If the EPS is same, that is indifference point. That is the only difference between 2 concepts. Comfortable? Sir, in case number 1, it's a all equity option. There is no interest. But in case number 2, you are paying an interest of 48 lakhs. Yes, sir. In case number 3, there is no what at all. That means earnings before tax will be EBIT. Here EBIT minus 48 lakh. Here again EBIT. Right, sir? Sir, 0.4 EBIT I have to pay as tax. Sir, here 0.4 EBIT minus 48 lakhs into 0.4 comes to 19 lakh 20,000 I should pay as tax. Here 0.4 EBIT I should pay as tax, right? From 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me. Here from 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me, minus 48 lakh minus 19 lakh 20,000 comes to 28 lakh 80,000. Comfortable? Here from 1 EBIT, if I pay 0.4 EBIT, then 0.6 EBIT will be with me. There is no preference dividend for first two case. But you are going to pay a preference dividend of 48 lakhs for the last case. Correct? So here 0.6 EBIT will be the residual earnings. Here 0.6 EBIT minus 28 lakh 80,000 will be the residual earnings. Here man, 0.6 EBIT minus 48 lakh will be the residual earnings. Comfortable? Under option number 1, how much is the number of equity share? 40 lakhs. We already calculated. Correct? Under option number 2, how much is the number of equity share? And in option number 3, how much is the number of equity share? So my EPS, earnings per share is equal to 0.6 EPS divided by 40 lakhs. Basically residual earnings divided by number of equity shares and residual earnings divided by number of equity shares. Now I am going to calculate the indifference point for financial plan 1 and financial plan 2. Are you all really with me? That means 0.6 EBIT divided by 40 lakhs should be equal to 0.6 EBIT minus 28 lakh 80,000 divided by 20 lakhs. Are you all really with me? Straight away this 40 lakhs and 20 lakhs. Straight away cut. This is 2 and this is 1. Pakka? So rewritten as 0.6 EBIT divided by 2 is equal to 0.6 EBIT minus 28 lakh 80,000 divided by 1. Comfortable? That means, sir, 0.6 EBIT is equal to 1.2 EBIT minus 28 lakh 80,000 into 2. Come to 57 lakh 60,000. Can I proceed? That means 1.2 EBIT minus 0.6 EBIT is equal to 57 lakh 60,000. Comfortable? That means 0.6 EBIT is equal to 57 lakh 60,000. So EBIT is equal to 57 lakh 60,000 divided by 0.6 comes to 96 lakh. That means if you are having an EBIT of 96 lakhs, whether you do the project with full equity or debt and equity, you will have the same EPS. Right? Immediately apply into the table. Don't write and all. If the EBIT is 96 lakh, residual earnings is 60% of 96 lakhs. So 96 lakh into 60%. 57 lakh 60,000. Following divided by number of equity share 40 lakh. So 1.44 is the EPS. In situation number 2. Take 60% of EBIT, which is 57 lakh 60,000 minus 28 lakh 80,000. Balance will be 28 lakh 80,000 divided by 20 lakhs comes to 1.44. Sir, magic, sir. Are you really with me? It's not magic, it's logic. Are you really with me? My dear lovable students, at the EBIT of 96 lakhs, whether you are doing the project with all equity or whether you are doing the project with equity and debt, you will be having EPS, same EPS of 1.44. Same EPS of. Now, for what purpose this topic I am studying? Chumma putting table, chumma finding answer. Is there any application? Yes. I will tell you what is the application. My dear lovable students, if the project, the new project, what you are going to do is actually having an EBIT of 96 lakh, I am indifferent. I am indifferent. Whether I go with the first option or second option, I will be having the same EPS. If my actual EBIT is less than 96 lakh, the finance manager is saying that if we do this project, we will be having an EBIT of less than 96 lakhs. I will only go with option number 1. I will not take the risk. I will always go with all equity option. Always go with all equity option. Sir, if the actual EBIT is more than 96 lakh, I will never choose all equity option. I will choose the equity and debt option because I am having more EBIT. That means I can bear the interest. I can bear the interest. Then my trading on equity will work. So this is very important for examination for your perspective. If they ask one more step forward, you will be in big trouble. Finding out the indifference point, okay, fine. Edu calculate pandra? Some table I put E. So my dear lovable students, you have to compare with the actual what? EBIT. Actual EBIT. Your actual EBIT may be equal to the indifference EBIT. Paka? Then your decision is indifference. That is. Whether I choose the equity option or whether I choose the debt option, I will get the same EPS. But if the actual EBIT is more than the indifference EBIT, then I will go with the debt option. Are you all really with me? If the actual EBIT is less than the indifference EBIT, then I will go with the all equity option. All equity option. This is the decision you are supposed to take. That's it. So we have calculated the indifference point between P and Q. We got the answer as 96 lakhs. The same thing only I have done, but I used to do using table approach. They used to do using formula approach. Better if you are feeling table, go with table. If you are a sir CV Raman, go with the sir mathematics. I don't have any problem. Are you all really with me? Yes, sir. Now the doubt is who is CV Raman? Go and Google it. Come on. Coming to the next one, man. Sir, I have to still perform 2 more projects between dash and dash. A2 and A3. That's what smartly I have done for all the project one table. Otherwise, every time you have to repeat. 3 hours will be swaha. So tell me, sir, 0.6E minus 28 lakh 80,000 divided by 20 lakh equity share should be equal to 0.6E minus 48 lakhs divided by 20 lakhs. Here, my dear lovable students, 0 cancel 1 right, sir? That means 0.6E minus 28 lakh 20,000 should be equal to 0.6E minus 48 lakh. 48 lakh. Are you really with me? If I solve this, sir, I can bring 0.6E minus 0.6E is equal to minus 48 lakh plus 28 lakh 80,000. Mathematically right. So this will be equal to 0 and this you will be getting some figure. 19 lakh 20,000. So 0 is equal to 19 lakh 20,000. That means between these two options, there is no concept of what at all? Indifference point at all. There is no level of EBIT where for plan 2 and plan 3, your EPS will be same. That match. Okay. A2 and A3, there is no indifference point. That's what the next one, man. Between proposal P and proposal Q, proposal Q and proposal R, sir, EBIT will be cancelled and become 0. So combination of proposal Q and R is not possible. But I have to calculate the 1 and 3 now. 1, 2 patachu, 2, 3 patachu, 1, 3 pakanum. Which is 0.6E divided by 40 lakhs should be equal to 0.6E minus 48 lakh. 0.6E minus 48 lakhs divided by 20 lakhs. Can I cancel? Yes, sir. 2, 1. Hello, sir. Yes, my dear lovable students. 0.6E divided by 2 is equal to 0.6E minus 48 lakhs divided by 1. That means 0.6E is equal to 1.E minus 96 lakhs. Can I proceed? So 1.2E minus 0.6E is equal to 96 lakhs. Can I proceed? 0.6E is equal to 96 lakhs. So E is equal to 96 lakhs divided by 0.6 comes to 160 lakhs is the EBIT. So at 160 lakhs EBIT, whether you are doing project with option 1 or option 3, you will be having the same EPS. Comfortable? Brilliant question. This question should be LDR for your examination. Last day before the exam, try this question. Because, sir, EPS, IS-EPS decision, financial break-even point concept, and also EBIT-EPS analysis. Are you really with me? Indifference point. What point? Indifference point. So this is a beautiful question, man. A brilliant. This question should be tried before the day of examination. Can we try one more question from this area? With that, the slot will come to an end. Current capital structure of XYZ Limited is as follows. Equity share capital of how much lakh? 7 lakh. Of face value of how much each? 20 each. Reserves and surplus of 10 lakh. 9% bonds of 3 crore. 11% preference shares of 3 lakh. Of face value of 5 each. Additional fund required for XYZ Limited are 5 crore. Totally 5 crore additionally we need. XYZ Limited is evaluating the following alternatives. Proposed alternative number 1. Raise the fund via 25% equity capital and 75% debt. 5 crore or 25%? 1.25 crores. 75%? 3.75 crores at 10% KD. PE ratio in such scenario will be 12. That means if I do this, market will react. Correct? I can't do whatever I want in my company because equity shareholders will be seeing like this. If I inject more debt into the capital structure, they will say that because you increase the risk. Proposed alternative number 2, raise the fund via 50% equity and rest from 12% preference shares. PE in such scenario will be what? 11. Any new equity share would be raised at a face value of, and any new preference share will be issued at a face value of 20 each. Tax rate is 34%. Determine the indifference point under both the alternatives. Indifference point. So, before I prepare the indifference point, let me calculate the basic data. Basic data. You tell me, today in market, what is the current market price of an equity share? 20 rupees because 20 each. How much number of equity shares are there? 7 lakhs. So 7 lakhs into 20 comes to 1 crore 40 lakhs is the equity share capital. Can I? Already company having reserves of 10 lakhs. Sir, already company having 9% bonds of 3 crore. Already having company having 11% preference shares of 3 lakh at the rate of 5 comes to 1 crore 50 lakhs. Add pannena 6 crore is the total capital employed. That means presently the company is having a value of 6 crore. It's a 6 crore company. Now we are going to additionally raise 5 more crores with 2 options with proposal number 1 and proposal number 2. Right, sir? So capital to be raised under both the proportion is 5 crores and 5 crores. Clarity? My dear lovable students, what is the proportion? In situation number 1, 5 crore into 25%, 1.25 crore and 5 crore into, sir, 50%. Angus, no man, debt. No, 25 and 75 and 50 and 50. Right. Sir, in proposal number 1, 25% equity means remaining 75% should be debt. Debt. Are you really with me? That means if 1.25 crores is equity means 3.75 crores should be debt. Debt. Total 5 crore. 5 or 6? 5 crores. 5 crores. Sir, here In proposal number 2, 50-50, 2.5 crores and 2.5 crores. Are you really with me? Yes, sir. Sir, so now what is a combined capital? Combined capital. Already you are having an equity of 1.4 plus reserves of 10 comes to 1.5, correct? Plus you are raising 1.25. So 1.5 plus 1.25 comes to 1.5 plus 1.25 comes to 2.75, but they have written 2.65, which is nothing. Reserves they have not clubbed. Yes, sir. So nothing. Old equity share capital 1.4 crores. Sir, new 1.25 crores. Total 2.65 crores. Able to follow? Anga. Already equity 1.4 crores. New 2.5 crores. Total 3.9 crores. This is the combined. Reserves anyway not going to change. All reserves will continue 10 lakh, 10 lakh. 9% bond will not change 3 crore, 3 crore. 10% debt will change. Sir, 10% debt, sir, proposal 1, 3.75 crores and there 2.5 crores. Sir, that's what? 3.75 crores. Right, sir? Debt. Paka? In proposal number 2, inga vande debt ku badala yaru varuva? Preference with 12% preference share capital. So 12% preference dash and 2.5 crores, which is new part, second part, 50%. And 11% preferences, you are already having 1.5 crores and the total capital employed will be 11 crore because already you are having capital of 6 crore plus additional capital, total 11 crore. This is a proposition of the 11 crore. Clarity? What is the interest for proposal number 1? I am supposed to pay. Sir, interest means, sir, 3 crore into 9% and 3.75 crore into 10%. So 3 crore into 9 plus 3.75 crore into 10. Total comes to 27 lakh and 37 lakh 50,000 come to 64 lakh 50,000. I should pay as interest if I am traveling through the proposal number 1. But in proposal number 1, do you have any preference share capital? Yes, sir. What is the preference share capital? 1 crore 50 lakhs into preference dividend of 11%, 16 lakh 50,000 should be the preference dividend. That's it. Proposal 1 calculations done. Interest for proposal number 2, simple. Sir, 3 crore into 9%. That's it. 27 lakhs. Comfortable. Preference dividend for proposal 2. Already I am having preference shares of 1 crore 50 lakhs. This into 11%. 2 crore 50 lakhs. This into 12%. Correct? So 1 crore 50 lakhs into 11% comes to 16 lakh 50,000 plus 2 crore 50 lakhs into 12% comes to 30 lakhs. Total comes to 46 lakh 50,000. Comfortable? That's it. Now all the basic data has been done. This I will not solve. I will be doing the table approach. How many options? 2 options. Only 2 options. So 1 indifference point. I have to write that EBIT minus interest. I will be getting earnings before tax less tax at the rate of 34%. Are you really with me? Yes, sir. You will be getting PAT, profit after tax, less preference dividend. You will be getting residual earnings divided by number of equity shares. You will be getting the EPS, earnings per share. Can we? I don't know EBIT, that is the suspense. Sir, interest under option number 1. 64 lakh 50,000. Under option number 2, 27 lakh. Up in 64 lakh 50,000 and 27 lakh. So it is E minus 64 lakh 50,000. E minus 27 lakhs. Can I? So 0.34 E minus 64 lakh 50,000 into 34%. 21 lakh 93,000. Following. Again 0.34 E minus 27 lakhs into 34% comes to 9 lakh 18,000. Can I proceed? That means, sir, 101 minus 0.34 comes to 0.66 E minus 64 lakh 50 minus 21 lakh 93,000 comes to 42 lakh 57,000. Again 0.66 E minus 27 lakhs minus 9 lakh 18,000 comes to 17 lakh 82,000. Comfortable? Under option number 1, there is preference dividend. Please note the preference dividend properly. Under option number 1, preference dividend is 16 lakh 50. And option number 2, preference dividend is 46 lakh 50. Please help me. What is the option number 1? 16 lakh 50,000. 46 lakh 50,000. Comfortable? My residual earnings will be 0.66 E minus 42 lakh 57,000 plus 16 lakh 50,000. 59 lakh 7,000. Is my calculation right? 0.66 E minus 17 lakh 82,000 plus 46 lakh 50,000, which comes to 64 lakh 32,000. What is the number of equity shares under option number 1? We have to calculate. 2 lakh 65,000 divided by 20. Correct then? So 2 crore 65 lakhs divided by 20 means 13 lakh 25,000 is the number of equity share for option number 1. Whereas for option number 2, 3 crore 90 lakhs divided by 20 comes to 19 lakh 50,000 should be the equity for option number 2. Sir, if we have added the 10 lakhs to this, our number of equity shares will be swaha. Correct? That's why they have showed it separately. You are not calculating WACC using market value weight. If that is the case, we could have included there. Fine. So I got the formula, which is residual earnings divided by number. Residual earnings divided by number. You should help me to solve this. Sir, 0.66 E minus 59 lakh 7,000 divided by 13 lakh 25,000 should be equal to 0.66 E minus 64 lakh 32,000 divided by 19 lakh 50,000. Right? First 3030 cancel. So 0.66 E minus 59 lakh 7,000 divided by 1325 should be equal to 0.66 E minus 64 lakh 32,000 divided by 1950. Ella 0 cancel பண்ணிட்டு 3 0 cancel out. By mistake, if you put 195, that's it, gone. John, you are gone. So 1325 divided by 5. Can I write this as 265? 1950 divided by 5. Sir, can I write it as 390? Still 5 la 365 divided by 5 comes to 53 or 73. Sorry, 265 divided by 5 comes to 53. That's the max I can do, correct? 53. And 390 divided by 5 comes to 78. I can cross multiply straight away. Is there any common number 53, 78 and all? No, sir. Better cross multiply. LCM. Alright, sir. So 78 into 0.66 comes to 51.48 E minus 59 lakh 7,000 into 78 comes to 46 or 4 crore. 4 crore 60 lakh 74,000. I know. 46 crores 7 lakh 46,000. Number Yes, sir. Yes, sir. Yes, sir. Leave it. So we have done it. No, should be equal to, sir, 0.66 into 53 comes to 34.98 E minus 64 lakh 36,000 into 53 comes to 64 lakh 32,000 into 53 comes to 34 crore 8 lakh 96,000. 96,000. Hello, sir. Is denominator comma or over? Hold sir. If now, can I bring all the E? 51.48 E minus 34.98 E should be equal to, sir, 46 crore 7 lakh 46,000 minus 34 crore 8 lakh 96,000. Fine. So 51.48 minus 34.98 comes to 16.5E should be equal to 11 crore 98 lakh 50,000. Example on the doubt or answer correct. E is equal to 11 crore 98 lakh 50,000 divided by 16 point E 72 lakh 63,636 point. At this EBIT, EPS of both the option will be one and the same. 72 lakh 63,636.36. Are you all really with me? Appreciating, huh? Sir, you know, this is a RTP May 23 question. May. Same question may be picked for examination. If you are having the courage to say that, that's your choice, your life. My dear lovable students, sir, like these questions will be coming, you have to practice this type of question by your own. Surely, you will ask one question. If you yourself are solving all that, how I will practice? Redo those questions. Don't worry, you are having another 3 questions for your practice. Sir, the same type of question, Akash Limited. This is a RTP May 2019. Try by yourself and check the answer. I have attached the answer for you. Then, number 2, Alpha Limited question. My dear lovable students, this is ICAI study material question only. Book back. ICAI book back only. You can try by yourself and you yourself can put the EBIT. You try everything if you hear when you will try. You try by your own. I have arranged the questions to you. And question number M, the financial advisor of Sun Limited. Even this question is also a ICAI book back question. Are you all really with me? Then you check yourself where you are going wrong. And these 2 questions are ICAI book back question. The same can be lifted for examination also. So don't take a risk. With this, officially we can declare that we are through with capital structure decisions, my dear lovable students. Are you really with me? First do the 3 questions which I have solved. Then do the next 3 questions which I ask you to try. We'll meet at the appropriate time with a different chapter. Till that, thank you. Bye-bye from ANM. Sir, very, very, very happy evening to all. Yes, sir. Sir, in the last class, we have done, my dear lovable students, the EBIT-EPS analysis. In that, I have given 3 questions for your checking. I believe that you would have tried. If someone is suffering from why this step has been done like that, I will quickly go through the answer for your easy benefit. Akash Limited provides you the following information. EBIT is 2,80,000. Less interest on debenture, 40,000 at the rate of 10%. So, they will be having debt of 4 lakh. EBT, 2,40,000. Less tax at the rate of 50% comes to 1 lakh. And so, the PAT, profit after tax, is 1 lakh and number of equity shares given 30,000. So, 1,20,000 divided by 30 comes to 4 per share. Price earning ratio 10. Price earning ratio 10 times. Company has reserves and surplus of how much lakh? 7 lakh. And required 4 lakh further for modernization. 7 lakhs plus 4 lakh is the total capital required. Return on capital employed is constant. That means whatever return on investment you are enjoying now, the same return on investment you will get for the new project also. Debt, that is debt bar, debt by debt plus equity ratio higher than 40% will bring the PE ratio down to 8. That means now 10 is the price earning ratio. If you are injecting more debt into the what structure, equity shareholders will start fear and it will start reflect the price earning ratio and the interest rate on additional debt to 12%. You are required to ascertain the probable price of the share. Probable price of the share. If additional capital is raised as only debt or if amount is raised by issuing equity shares at the ruling market price. This is a RTP May 2019 question. Can we? What is the additional fund required? 4 lakhs. Total 11 lakhs. Anyway, we are having reserves and surplus of 7 lakh. So monetary money required. So plan number 1, if the 4 lakh is raised as debt. Plan number 2, if 4 lakh is raised by issuing equity shares. Right, sir? What is the earnings before interest and tax? Sir, have they given anything? Yes. Now the currently profit, sir, EBIT of how much? 2,80,000. Can we calculate? Yes, sir. Tell me, man, what is the, this will complete and come up. What is the existing equity share capital? Existing equity share capital, 3 lakhs. Already given in the 10% debenture, we calculated by reversing the interest rate. Total comes to reserves and surplus, already given in the question as, so total capital employed is 14 lakh. Existing. Correct? For an investment of 14 lakh, we are getting a return of 2,80,000. That means the return on capital employed will be 20%. They said that the return will be same even for the new project. Yes, sir. New project value 4 lakhs plus 7 lakh, 11 lakhs. 11 lakhs into 11 lakhs is the value of the new project. Illa sir, only 4 lakhs. Velil vaangiradhu. 7 lakh already there as reserves and surplus, means part of the old project or part of the new project? Part of the old project. That means new project require only capital of 4 lakhs. Right? So you tell me, Ingava, when you do the new project, come on, let me. When you do the new project, I can't do for old project company number 1. For new project company number 2. It's all are happening in one company only, one share market only. Clarity? So what is the total capital, existing capital employed? 14 lakh. To that capital employed only I can add the new capital of how much lakh? 4 lakh. So 18 lakh will be the total capital employed of the existing company. Yes, sir. Yes, sir. So into how much percent? 20%. So 3,60,000 will be the EBIT. Don't take the extra EBIT. Take the full EBIT. That is from the old project plus the new project. Right? Less interest on old debenture. Already you are having debenture. Yes, sir. How much value? 44 lakh into 10%, 40,000. Enough clarity. Less interest on the new debt. How much is the debt? 4 lakh into 12%, 48,000. Second case, there is no what at all? Debt at all. So earnings before tax, 2,72,000 and 3,20,000. Let's tax at the rate of 2,72,000 into 50, 1,36,000. 3,20,000 into 50, 1,60,000. What is the earnings available to equity shareholder? 1,36,000 and 1,60,000. Right? In option number 1, we have not raised equity at all. So the existing number of equity shares will be the new equity shares. Comes to 30,000. So 136 divided by 30. 4.53. 4. But in option number 2, we have raised the equity. Right, sir? So number of equity shares to be raised in plan number 2. What is the additional capital? 4 lakh. What is the existing market price? 40. How much number of equity share? Already you are having 30 plus 10 comes to, that's why denominator, sir, in second case 40,000. Comfortable. Which comes to EPS of 4 per share. Sir, is the price earning ratio given, not given? Given. So you know that price earning ratio is equal to EPS. Super. Sir, what is the existing? If you inject debt into the capital structure, PE will fall to 8. Is equal to MPS. I don't know. That's what they want in the question. Divided by EPS. I know. How much EPS? 4.53. Apo 4.53 into 8 comes to 36.24. Correct? But if you are injecting what into the capital structure? Equity into the capital structure. The price earning ratio will be same at 10. So 10 is equal to MPS divided by EPS. What is EPS? 4. 4 into 10, 40. What is the existing, sir, market price? 40. Same. Are you really with me? Yes, sir. That's it with regard to that question. So debt equity ratio, if we raise 4 lakh as debt, so total capital employed 18 lakh. Out of that 8 lakh will be debt. How 8 lakh? Already 4 lakh plus new debt 4 lakh. 4 lakhs plus 4 lakh comes to 44.44%. Right, sir? Is there any cutoff given in the question? Yes, sir. Yes, sir. If the debt is higher than 40%, then only PE will come down. Yes, sir. Now the debt in the capital structure is 44 point. As the debt equity ratio is more than 40%, PE ratio will be brought down to 8 in plan number 1. Comfortable? I hope that you also got the right answer. If you are stuck anywhere, why this has happened, this is explanation for that question. I'm coming to illustration number 2, the second question. Alpha Limited require fund amounting to how much lakh? 80 lakh for its what project? New project. So already existing company, man. For new project, 80 lakhs requirement. To raise the fund, company has following 2 alternatives. To issue equity shares of at par amounting to and borrow balance amount at the rate of 12%. Up 80 lakhs, 60 lakhs pochna, 20 lakhs by way of debt. Or to issue equity shares at the rate of and 12% debenture in equal proportion. That means 40 lakhs equity. Income tax rate is identify the point of indifference between the available 2 model of financing the state. Which option will be beneficial in different situation? Sir, same simple question, sir. Can we go through, sir? Amount, what is the loan? 80 lakhs. Plan number 1, equity 60 lakh, debt. Plan number 2, equity 40 lakhs, debt 40 lakhs. Plan number 1, interest payable, debt 20 lakh into 12% comes to 2 lakh 40,000. Plan number 2, debt 40 lakhs into comes to 4 lakh 80. We have to find out the point of indifference. That table we have to put. E minus interest, you know, correct? E minus 2 lakh 40, E minus 4 lakh 80. Sir, pay the tax at the rate of 30%. You will get the PAT, which is on the 0.7 E minus some X figure, whatever it may be, 1,44,000. 0.7 E minus 4,80,000 order 3,36,000. Yes, sir. Is there any preference dividend? No, sir. So this will be the residual earnings divided by number of equity shares. Case number 1, 60,000. Case number 2, 40,000. You will be getting some equation. Correct? Close it. Sir, you will get EBIT of 9,60,000. This is for both the plans. Now, what they want? What they have asked? Identify the point of indifference between the available 2 model of finance and state which option will be beneficial in different situation. So for that, we have to calculate the EBIT-EPS. Can we? EBIT same, different? Same. Hello, sir. Less interest at 12%. Padana calculate panna 2,40,000 and 4,80,000. Same na? Nothing has been given, man. Wait. Sir, wait, sir. You got a EBIT of 9,60,000. That is the what point? Indifference point. At what point? Indifference point. Sir, both options are one and the same. So I am assuming that EBIT to be 9,50,000, which is less than indifference point. Sir, some assumed figure. Sir, can I take 9,40,000? Daralama. Anything less than 9,60,000. Hello, sir. Why? I am going to prove something. Wow. Sir, what is the EBIT? 7,10,000 and less tax at the rate of 30%. You will get a PAT. 4,97,000 and 3,29,000. Number of equity shares. Sir, we already find out 60 and EPS 8.28 and 8.23. So, what is the comment? This is very important. In situation A, when expected EBIT is less than EBIT at what point? Then plan 1 is more viable because it is having higher EPS. The advantage of EPS would be available from the use of equity capital and not from the debt capital. If the yesterday only I told, yes, sir, if the actual EBIT is exactly equal to indifference point, you choose whatever plan you want. You put a toss, plan number 1 or plan number 2. Whatever coming, you choose it. But if the actual EBIT is less than, choose equity option. But if the actual EBIT is more than, come on, example, EBIT is assumed to be 9,70,000. What is the specialty of that? More than? EPS அதிகமா வரும். Debt option வரும். Plan number 2, look at it, 8.58. If you want 970, less interest fixed, you will get the earnings before tax, you have to pay the tax, you will get the PAT, same equity share, you will be getting the EPS. Comment. In situation B, read it. When expected EBIT is more than the EBIT at the indifference, then plan 2 is more viable, hence it is have a higher EPS. The use of fixed cost source offer would be beneficial from EPS viewpoint. In this case, financial leverage would be favorable. The problem can also be worked out assuming any other figure of EBIT, Kandipa, which is more than 9,60,000 and any other figures less than 9,60,000. Alternatively, the answer may also be based on the factors or governing the capital structure like cost, risk, control, etc. principles. Hello, sir. Very easy question. Basically, this should be the first concept question of this. Because for what purpose we are using the EBIT is depicted by this question. Correct? I hope that you are able to appreciate. The last question from this. The financial advisor of Sun Limited is confronted with the following two alternative financing plan for raising 10 lakh that is needed for planned expansion and modernization. Total money required 10 lakh. I am having alternate number 1, alternate number 2. Okay, 1. Issue 80% of fund with 14% debentures. Face value 100. At par and redeemable at premium of 10% after how many year? 10 year. And balance by issue equity share as 33.1/3 premium. Be very clear with the terms. Okay, evlo lakhs theve? 10 lakhs. 14% debenture. 8 lakhs. Right? Face value of 100 at par. And redeem at premium of 10%. Oh. So when I redeem, I should pay 8,80,000. This is the redemption value. This is the net proceeds. Okay, and balance by issue equity share at 33.1/3 premium. Balance how much? 2 lakhs. 2 lakhs divided by 3. But 2,66,667 is the net proceeds. Redemption value 0 da. Because I will not redeem equity share ra. Sir, if I do like this na, 10,66,667 will get. I don't need that. I want only 10 lakh. Correct dane? Yes sir. Wait. Alternate number 2. Raise 10% of the fund required by issuing 8% irredeemable debenture. 10% at par. And remaining by issuing equity shares at the current market price of 125. Currently firm has an EPS of 21. Okay. Modernization and expansion program is expected to increase the firm's earning before interest and tax by how much annually? Apo, firm's condensed balance sheet for the current year is given below. Balance sheet. Current asset 16 lakh. Plant and equipment 34 lakh. Total 50 lakh. Current liability 5 lakh. 10% long term loan 15 lakh. Reserves and surplus 10 lakh. Equity share capital 20 lakh. Total 50 lakh. Additional information. Mudikle no question. Okay, right. However, the finance advisor is concerned about the effect that issue of debt might have on the firm. Average debt ratio for the firm industry is how much percent? He believes if this ratio is exceeded, Kandipa, P ratio of the company will be 7 because of the potentially greater risk. Right? If the firm increases equity capital by more than 10%, he expects P ratio of the company will increase to irrespective of the debt ratio. Assume tax rate of 25%. Assume target payout ratio under each alternative to be 60% for the next year. And growth rate to be 10% for the purpose of calculating cost of equity, that is K. Suggest with reason which alternative is better on the basis of each of the below given criteria. EPS and the MPS. Financial leverage. Weighted average cost of capital and marginal cost of capital using book value weight. Sirappana, Taramana, Sambo. If the same question comes in examination, sir, என்னதான் நீ சொல்ல வந்திருக்க அப்படின்னு புரியறதுக்கே காலம் கொஞ்சமாகும். This is a book back question which is there in the ICAI study material. Just answer to me the details. Calculator. Calculation of equity share capital and reserves and surplus. Alternate number 1. You tell me what is alternate number 1. என்ன பண்ண போற? 8 lakhs of debt, 2 lakhs of equity. Right? Okay, sir. Wow. Equity share capital. Already how much there? Respond பண்ணுங்க எல்லாருமே. 20 lakh. How much you are going to issue? 2 lakhs. So total, this is at premium. How much premium? So this will be 133.333333. So the into 100 will be 1 lakh. Total, man. 21 lakh 50,000. FD sir. Because this 20 lakh will be 20 lakh itself. It's dead cost. Past. Only for this 2 lakh. Don't issue 2 lakh. Because if you are issuing 1 lakh 50,000 equity itself, I will get 2 lakh. Calculator 1 lakh 50,000 into 133.33333333. I will get 1 lakh 99,999. That's why 2 lakh. Sorry, because if I issue equity of 2 lakh, I will get more than 2 lakh. And the extra cash which I will do. Correct? Unnecessary KE will come. Hey, Purida. So just issue 21 lakh 50. Reserves. Already I am having. Then. Premium. Reserve could add out. Sir. Security premium increase out in the balance sheet. Sir, because you are going to issue only 1,50,000 of equity. Hello, sir. Then reserves. 50,000. Purida. Yes, sir. So 10,50,000. Total. 30. Okay. Hold capital. 30 lakhs total. Extra. 2 lakh tallied. Because out of 10 lakh, 8 lakh is a debt. Remaining 2 lakh is equity. But not entire 2 lakh. Accounts எல்லாம் டெஸ்ட் பண்ணிருக்காங்க அவ்வளவுதான் வேற எதுவும் இல்ல. They are saying that book 1,50,000 rupees under the equity and balance 50,000 rupees under the reserves and surplus. Can I proceed? Alternate number 2. What is alternate number 2? 10% debt, 90% equity. Have 90% 9 lakh. But, sir, share capital will change, sir. Issue price will change, sir. Wow. Calculator 9 lakhs divided by 125 into 100 comes to 7,20,000. Hey, getting up 20 lakh plus 7 lakh 20. 27 lakh 20 will be the equity. But you will be issuing 9 lakh minus 7 lakh 20. 9 lakh minus 7 lakh 20 comes to 10 lakhs plus 1 lakh 80. 11 lakh 80,000. I hope concept clear. Keep a capital structure plans. Alternate number 1 and alternate number 2. Come on. Equity share capital. Now finalize panna. 21 lakh 50,000. 27 lakh 20,000. Reserves and surplus. Finalize pannita. 10 lakh 50. 11 lakh 80. Hey, matching. Yes, sir. Madam? Yes, sir. 10% debt. Already given. 15 lakh. 15 lakh. Hey, all is existing. Will not change. 14% debenture. New. Under option number 1. 8 lakh. That's premium. Only redemption premium. Sir, inga dash. Sir, 8% irredeemable debenture. 1 lakh. 10 lakh into 10%. Mudila, Kirtan. Total capital employed. Tell me. 55 lakhs, 55 lakhs. Hey, clear? Calculation of present EBIT. What is the EPS given? 21. Total number of shares available. Existing. 20,000 la? 20? Illa. What by what? 20 lakhs divided by 20,000. Calculator. What is the earnings available to equity shareholders? 20,000 into 21. 4 lakh 20,000. Hey, reverse working da? EBIT minus interest. Hey, EBIT. All those stuff. So what is the tax rate? 25%. So this will be 75. Correct? 420 divided by 75%. 5 lakh 60,000. Ennapa? Yes, sir. Now I am the profit before tax. Liya? Yes, sir. I have to add interest. Existing interest. 15,000. 1,50,000. Existing EBIT. 7,10,000. Right, sir. They themselves given the addition in the EBIT as 2 lakh. So total EBIT 9,10,000 will be the new EBIT if I accept the project. Evaluation of financial plan based on EPS, MPS, financial. Everything I am going to calculate. EBIT. Purincha? Already interest. Super. 1,50,000. 1,50,000. 1,50,000, 1,50,000. Sir, new debenture 14%. எவ்வளோ இஷ்யூ பண்ண? 8 lakhs. KD 8 lakh into 14. 1,12,000 nil. என்னப்பா? 88% irredeemable debenture. Value 1 lakh into comes to 8,000. Profit before tax you will get. Apply tax at the rate of 25%. You will get the PAT. Correct? Number of equity shares தெளிவு. Existing 20. Equity 1,50,000 divided by market value 100. அப்படின்னா 1,500. 21,500. புரியுதா? எப்படின்னா existing 20 new 1,000 total comes to right. Next one, existing 20 new total increase 9 lakhs security premium இருக்கா 7,20,000 divided by 100 7,200 அப்ப 27,200. Comfortable? This is the EPS man. SR which is nothing but PAT divided by number of equity shares. Sir, applicable PE ratio I have to calculate. Can I calculate that? Can I calculate the applicable PE ratio? Yes sir. Fun பண்றாங்க boys இங்க. Right. Sir, debt 15 lakhs existing plus new total 23 lakhs. Then 15 lakhs plus 1 lakh 16 lakhs. புரியுதா? Total capital employed 55 lakhs already we worked out. இப்போ வா debt equity ratio calculator. Debt 23 lakhs divided by 55 lakhs into 100. 41.82% debt. Here 16 lakhs divided by 55 lakhs comes to 29.09% debt. என்னப்பா எவ்வளோக்கு மேல போன பிரச்சனைப்பா? ரீட் பண்ணி சொல்லுங்க. அப்போ வா what is the change in equity? 1,50,000. Super. Second case, change in equity. Brilliant. 7,20,000. Can I change the percentage change in equity? 1,50,000 divided by 20 lakhs into 100 comes to 7.5%. Next one, 7,20,000 divided by 20 lakhs into 100 comes to 36%. First case 10% மேல போல. அப்படின்னா what is the existing P ratio? 7 will follow. Yes sir. ரெண்டாவது போச்சு 8.5. Already given man. இப்போ மேல வா. Applicable P ratio. What? I am having EPS P ratio. Can I find out the market price? எவ்வளோ? Multiply பண்ணி சொல்லியா? 22.60 into 7. 158.2. 20.74 into 8.5. 170. 20.74 ஃபுல்லா வரலையா? நிறைய இருக்கா? அதாவது 5,64,000 divided by 27,200 ஃபுல்லா போடுங்க. ஃபிராக்ஷன் வருது. into 8.5. 176.25. கரெக்டா? Do you know the financial leverage formula? மறந்துட்டியா? தெரியும். என்ன ஃபார்முலா? EBIT divided by EBT. What is the EBIT? 9,10,000. EBT 6,48,000. So 9,10,000 divided by 6,48,000 comes to 1.40. அங்க 9,10,000 divided by 7,52,000 comes to 1.21. எல்லாமே எடுத்தாச்சா? I have to calculate the cost of equity. Hello? Can we calculate the KE? Because they want to whack. Whack calculation கேட்டிருக்காங்கல்ல? Come on. Full FM revision by this one question. Yes sir. Because leverage, cost of capital, capital structure theories, everything will come. Come on. Cost of equity. What is the EPS? Alternate number 1. 22.6. இங்க இருக்கு 20.74. Right? Sir, dividend payout ratio given. EPS into how much percent? அப்படின்னா calculator. 22.60 into 60%. 13.56 and here 12.44. Correct? Growth already straight away given in the question as. Sir, MPS 0 just now you find out. Under option number 1, 158.2, 176.29. புரியுதா? Now this formula I should come. Sir, don't ask me from where this formula came. Sir, cost of capital K is equal to DPS 1 divided by MPS 0 plus G. Correct? What is the DPS 1? 13.56 is DPS 0. Correct? Into 110 percentage comes to 14.916 divided by existing market price 158.2 percentage 9.43. Correct? Or doubt? K is equal to DPS 1 divided by MPS 0 plus G போட்டிருக்காங்களா? Yes sir. Go to question. What is the logic? Assume tax rate to be 25%. Assume target dividend payout ratio under each alternative to be 60% for the next year. And growth rate to be for the purpose of calculating cost of it. What? Next year also perpetual should be there, no growth. What is the logic? Why they have not put no notes, nothing? What is the dividend payout ratio? Abdina 40% they are holding. That means there should be growth. Perpetual growth should be there. But they have not considered growth. Sir, sir, actually, do you know this formula? DPS 1 divided by MPS 0 plus G. Why this formula has not used? Why DPS 1 divided by MPS 0 has been used? Introduce பண்ண போறாங்க, right? %60% this year they gave dividend, 40% they are holding. What sir? Ama sir. Yes sir, correct sir. Either I have to choose alternate number 1 or alternate number 2. If I add the growth, let me ask you a question. Is the DPS is same or different? Then automatically G will also be different. That will affect my decision. Because this is not one and the same man. Yes sir. இதுக்கு மேல 10% போடுறதும் இதுக்கு மேல 10% போடுறதும் difference இருக்கு. கரெக்ட்டா? So don't consider that growth. But I can't consider DPS 1 எடுக்காம இருக்க முடியாது. Because dividend will grow. I can't see the perpetual growth. When I will get perpetual growth? Only after I take the decision. I am going to take the decision. அப்ப decision எடுக்கும்போது when I consider, if I consider the growth, my decision may go wrong. So they said that DPS 1 divided by MPS 0. So 13.56 into 110% comes to 14.916 divided by 158.2 comes to 9.43% is the KE under option number 1. Option number 2, 12.44 into 110% divided by 176.29 into 100 comes to 7.76 will be the KE under option number 2. Mudile, I have to finalize debt. So many debt are there. 10% term debt, easy. 7.5%, which is nothing but I into 1 minus T. Second one also I into 1 minus T, because existing only, no. 14% redeemable debenture. I have to calculate. Yes, a redemption. Redeemable debenture. KD is equal to I into 1 minus C, which is 14 into 1 minus C plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. What is RV? 110 minus NP life 10 years. Average liability. Hello sir. I will get 10.95. This option I don't want. 8% irredeemable debenture. Irredeemable. First option not there. Sir, 8 into 25% tax rate will be there. Up 8 equal to 25% bona remaining. 6 man. A 1 minus 3 man. I into 1 minus 3 man. Now everything pakka. Now, sir, whether I can calculate the WACC? Yes, sir. This is under alternate number 1 and this is under alternate number 2. Alternate number 1 can be equity share capital. Weight. We have to calculate weight. Everything. Total. You have to say equity. The pathway. This one. This you take photo or something when I go down. 21,50,000 divided by 55 lakhs comes to 39.09. That's what they have written here as 39.09. Like that, you have to calculate weight for everything. Just now KE done. KR is equal to KE. Hello. Existing debt 7.5. New debt 10.95. Sir, calculate the WACC. You will get 9.12. Comfortable. Alternate number 2. Weight will change. But individual cost of capital will also change. New KE yes, sir. Automatically WACC will change. Right, sir? Automatically KO will also change. Correct? Sir, have they asked any decision? Suggest with reason which alternate is better. You have to write conclusion. Sir, as per EPS, market price, MPS. So you have to write EPS. What is the EPS for alternate number 1? 22.60. Correct, ama? Nambalama 22.60. Alternate number 2. 20 point. Conclusion. Alternate number 1. Based on EPS. Number 2. MPS. Wait. MPS 158.2. 176.29. A2. Alternate 2. Train bogi solra. Financial leverage. Yes. 1.4. 1.21. A1. Better having highest financial leverage. Right, sir? Next one. Back. 9.12. 7.66. K1 na. KO should be less. Hey, capital structure theories and 2 firms are alike in all aspects except capital structure. You will choose highest KO. No, sir. Every company should choose lowest KO. Thambi? Yes, sir. A1 or A2? A2. The summary table you should write. And which is having highest? Equal. Tell me, sir. 1.21. Highest, sir. Sir, combined leverage should be less, sir. Operating leverage should be less, sir. Financial leverage should be highest, sir. Because you are having EBIT more than indifference point, sir. Trading on equity work out, sir. Financial leverage, equity shareholders. Sir. Sir, debt கம்மியா இருந்தா எப்படி சார்? டெட் கம்மியா இருந்தா நஷ்டம் தானே சார்? டாக்ஸ் பெனிஃபிட் சார், இபிஎஸ் சார், எல்லா டவுட்டும் எல்லாருக்கும் வருது. பிகாஸ் திஸ் இஸ் நாட் ஏ சார் EBIT-EPS. This is FM question. Yes, sir. Do only a student who knows financial management will be able to solve this. Sir, clear, sir? Doubt clear, sir? Yes, sir. Inga vaanga, sir. KO, highest, lowest, sir. Lowest KO should be chosen. Right, sir? This is the conclusion you should write, sir. Any doubt before I close this part? Madam? Clear, sir. Everything clear, sir. Okay, sir. Sir, you said it. But 1 second, sir. Sir, with this, all the 3 questions comes to an end. Right, sir. Check your answers.